Welcome back. Well, it's a big election year with more than 20% of the world's population going to the polls, and politics has become a significant source of volatility in financial markets. So how do we navigate markets amid so much noise? Schoders' Kondi Nkosi joins me now to share his insights. Thank you so much for your time, Kondi. Now, of course, there's this deep connection between the global political landscape, particularly this year, and also sentiment in the markets. Is this because there's big change in the air that's making investors unsettled?
Thanks for having me. First of all, really appreciate the opportunity to share our thoughts with you. Yeah, 100% right. I think the point you made about, more than 20% of the world going to the polls this year, I think that number is probably even closer to 50%. So it's quite an historic year from an elections perspective. And I think this is quite important because clearly the outcome of elections can have impact on policy. And policy sets the tone for the environment in which companies operate. So there's a very clear impact on markets. Elections by their nature are very, very difficult to predict the outcome thereof. I mean, we can look at our local markets here with what the polls were saying versus where things ended up. It's very hard to get the point estimate right. So in the lead up to elections and through the election period, I think there's a lot of unknowns. And, you see markets react as they try to digest this news that comes out. But as I said, it's very difficult to predict the outcome of these things. So, it's normal to expect some volatility in the lead up to elections. And from an investor perspective, I think it's even more important for one to remain calm and not be too reactive to the noise, because it can lead to, let's say, inefficient decisions. So it's almost a case of expecting the volatility and kind of navigating that through the process in the lead up to the elections.
Well, Kondi, it's been very interesting to see market reactions to all the noise that we see in news publications. Would you say that also these knee-jerk reactions are maybe overdone, and that if you're a long-term investor, then you should be able to stomach the volatility no matter how bad it gets?
Yeah, that's right. I mean, in theory, 100% right. Practically speaking, it does take quite a bit to remain calm in those environments. I mean, I always liken it to sort of in the heart of the pandemic, the coronavirus pandemic, when it appeared that everything was falling apart. But if you look at the guys or the investors that did well coming out of that environment, it was those that managed to keep their heads. To your point about the overreaction, that can lead to both risks as well as opportunities if you do keep that calm head. So our view is definitely around, keeping an eye on the long-term picture, going back to the why you're doing what you're doing, the objectives that you're trying to achieve, remaining calm in that environment and taking advantage of the opportunities as they come up.
Earlier on, you spoke about how policy really sets the tone for the environment in which companies operate in. What would you say, though, in terms of, the economic kind of growth rates that companies operate under? Are you maybe able to find comfort, and can you get around subdued economic growth within equities and still get good returns?
Yeah, you can. I think for us, it's really around what's the information edge that you have with regards to companies operating in any particular environment. So whilst the macros may be challenged in a particular environment, it doesn't necessarily mean that it's bad news for all companies. I mean, to use a very simple example, you can have a company operating in a particularly difficult, or that's got a home base in a particularly difficult economy, but they've got fairly diversified business, so they earn revenues in other jurisdictions, or they happen to be in a sector within that economy that's doing well. I mean, the economic data by definition is an aggregation of a lot of different sources of information across multiple sectors, across multiple industries, etc. You could have certain industries that are doing very well. At the same time, it could be a cyclical, period that these companies are going through. So, maybe the price that they're trading at doesn't justify the through the cycle prospects of these businesses. So, I mean, it's not to say that if economic growth is not looking great, it doesn't mean that there aren't any investment opportunities. Many times it's quite the contrary.
All right. Well, besides our election, Kondi, another election that the world will have its eyes on is in the U.S. And of course, it seems that it might be a tight race between the Democrats and the Republicans. And obviously, a big theme within equities for the last few years has been the green energy transition. Is there a significant divergence between, support of the green energy transition and, essentially green energy transition companies between the Democrats and the Republicans?
It's a great question, and it kind of stems to the Inflation Reduction Act that was enacted in the U.S. back in 2022 under the Democrats' leadership. And effectively, that piece of legislation covered a relatively broad set of principles. One was around prescription drug reform. There were elements around taxation, but also, to your point, around the energy transition. There were certain elements of that incentivized this transition away from fossil fuel-based energy generation and energy consumption towards kind of the greener energy forms. Now, there have been some postulations from the Republican side of the debate where certain statements have been made around repealing certain parts of that Inflation Reduction Act, particularly around this energy transition themes. We probably don't have enough time to get into the detail there, but the end result of this is that if it is in fact a Republican victory at the polls in November, and perhaps the Republicans being in control of Congress, you could see potentially some of these elements of the Inflation Reduction Act being repealed. Now, as we said at the top of this interview, it's notoriously difficult to predict the outcome of these elections. But if it's a Democrat victory, then you're likely to see the Inflation Reduction Act carry on as is. But if it's a Republican victory, you could see some repeals or some scaling back of the Inflation Reduction Act and the principles thereof. As a result, as we lead up to the elections, again, we anticipate quite a lot of volatility in these energy transition names as the markets digest the implications of this potential policy shift on these companies and how they're operating. So again, it's this point of, whilst the markets digest this information that's coming out of the election and the policy implications thereof, you could see some volatility in these names. Again, going back to the point of, as an investor, it's your, dare I say it, responsibility to kind of take advantage of any of these market movements in your, to the favor of your investors. So again, we are looking at this segment quite closely and trying to see the areas that we can play in terms of this energy transition.
Ooh, quite a lot of uncertainty there, and of course that is a very difficult pill to swallow by investors. But of course we will be looking deeper into these developments as the year progresses. Thank you so much for your time and for your insights there, Kondi. That was Kondi Nkosi, country head for South Africa at Schoders.